And here we start. Of course, given a choice, if we were to deliver this session face to face, I would have loved to make this session very interactive, giving all of you an opportunity of asking me questions from time to time and also give answers to those questions. But we are in the virtual mode, so let us try and make as best as possible of this opportunity of discussing valuation and the important aspect under various statutes. What we covered in part 1 was the valuation as such and the process of business valuation, different approaches and methods of valuation, and also the important aspect of valuation from the perspective of the Companies Act. Before we come to the second part of this session, and that is where we are going to cover number 1, we will be looking at the income tax, the provisions with regard to valuation in the Income Tax Act, especially Rule 11U and Rule 11UA. And then we will be looking at the valuation report, how to prepare a valuation report, and then we would also be looking at the ethics. Remember, as we discussed yesterday, the prime objective of the Government of India behind bringing out the valuation rules is to ensure good corporate governance, to enhance the level of good corporate governance and better decision making by the corporates. So just to have a quick recap so that all of us are on the same page. What is value? Value is nothing but utility of an asset. An asset that has a utility, it has a value. An asset that does not have a utility, it does not have any value. What is valuation? Valuation is, simply speaking, is quantification of utility of an asset in terms of money is valuation. Why valuation? Why do we do valuation? We do valuation because we have to take a decision. Any decision in the corporate, organic, inorganic, has to be based by the rationale, and that rationale comes from the valuation, and that is why the valuation. So remember, in simple words, if I should tell you, I would say every corporate decision is preceded by valuation. Every corporate decision is preceded by valuation. What we try and find out in the valuation or through the valuation is the fair value. What are the premises for valuation or the premises of valuation? Number 1 is the going concern, and number 2 is the liquidation value. Let us quickly also see the approaches and the methods as we discussed yesterday in the part 1, just to be on the same page. So what are the approaches? Income approach, market approach, and the asset approach. Asset approach is also known as cost approach. So remember, whenever you are reading about valuation, sometimes the literature may refer it as cost approach, or sometimes it may refer it as asset approach. So at both the places, they are meaning the same thing. Under the income approach, you have the income capitalization method, where you use the past income of the company, and the other method under the income approach is the discounted cash flow method, and that is where you use the future income or future projected cash flow of the entity. Under the market approach, first you use quoted price as the basis for the purpose of valuation, assuming that the entity for which you are doing the valuation is a listed one. So in case of a listed entity, you will refer the quoted price. If the entity is not listed, then you will go for the comparable company method or comparable transaction method. Under the asset or the cost approach, there are four methods. One is book value method, second is adjusted book value method, third is the replacement method, and the fourth is the liquidation value method. Yesterday in part 1, we understood that for being good in valuation, we need two things. Number one, we need to have good understanding of India's 113, which is on fair value measurement, and also the valuation standards. Valuation standards issued either by the International Valuation Standards Committee, IVSC, or by the Institute of Chartered Accountants of India. So you can refer either of these two standards, and it is recommended that you must start your journey on the path of the valuation by getting a very good hold in India's 113 and also in any of these valuation standards. We have understood that quoted price is level 1 input as per the India's 113. Comparable company transaction or method, comparable company method or comparable transaction method is the level 2 input, and the discounted cash flow method that we use for the purpose of arriving at the value of a business using discounted cash flow, that is your level 3 input. We understand that fundamentally all over the globe, discounted cash flow method is considered to be most dependable and reliable, provided the financial projections used for arriving at the future free cash flows are done on the realistic basis, and also the cost of capital used for the purpose of converting the future cash flows in terms of present value by discounting them is also an authentic one. Market approach, of course, it is certainly useful, but in both the cases, in case of market approach and in case of the income approach, it is always better to cross-check your valuation as per the discounted cash flow method with the market approach, and in case of the market approach with the discounted cash flow method. The cost and the asset approach, remember, is to be used only in case of when the company is not a going concern or when the company is going to close down, and that is where it will basically give you the downside value. It will basically give you the downside value in case if you are looking for buying a company or selling a company. The valuation process starts with the understanding of the purpose of valuation, and remember, as I have mentioned already, any corporate decision is preceded by valuation. So that means anything and everything that you do in corporate, irrespective of your size, irrespective of your geography, irrespective of the constitution of your business, irrespective of the product of the company, of your company, every valuation will start with a purpose. Yes, what is the purpose of that valuation? And the purpose can be anything. It can be compliance with the financial reporting, it can be for the transaction, it can be for dispute resolution, and it can be for many other purposes, for the inorganic decisions or organic decisions. Then the next step is you identify the premise of valuation, which can be going concern or which can be the liquidation value premise. Having done that, then you determine the standards of value, which can be four. Number one, it can be fair value, it can be fair market value, it can be specific value, or it can be intrinsic value. The next step that you have to follow is the compilation and collection of the data for the purpose of arriving at the valuation. Of course, whenever you're doing valuation, whether you're using the income approach or the market approach or the cost approach, ultimately you will need a lot of data and details and information for arriving at the valuation, and that is what you would do. Having done that, then you decide as to which method or the approach you must deploy for the purpose of arriving at the valuation, and that of course will depend on your purpose, and your purpose will depend on the premise of the valuation, and that is how you will figure out as to which method or which approach you must use for the purpose of arriving at your valuation. And once you do this, you will be reaching at your fair value. As discussed yesterday or in part 1, there are a lot of opportunities which are available for the valuation professional So there can be 5 kinds of valuation professional. Number one, people who are registered valuers, registered with IBVI. Number two, those who are merchant bankers. Number three, the chartered accountants. And number four, the company secretaries and cost and management accountant. And number five is the people who are either a chartered accountant, cost accountant, company secretary, or a finance professional who's got 10 years of work experience and has got himself registered under section 34AB of the Wealth Tax Act 1957. So that is the fifth category of the valuers which are available in our system, in Indian corporate system. And different valuers can have different scope. So basically someone who is a registered valuer and also a chartered accountant and is also registered with the income tax department under section 34AB, he can do the valuation under the Companies Act, under the Income Tax Act, as per the FEMA, and also as per the SEBI regulations. Incidentally, fortunately, I am privileged to have all these three categories. So I'm a registered valuer, also a practicing chartered accountant. I'm a proud member of the Institute of Cost Accountant and also the Institute of Company Secretaries, but I'm practicing as a chartered accountant. And I'm also registered with the Income Tax Department under Section 34AB of the Wealth Tax Act for doing valuation as per the Income Tax Act. Going forward, all the valuations will be done by the registered valuers only, and that is the plan that the government of India has as it stands today. Just to tell you a brief about myself, I am a valuation professional, independent director. I have authored 2 books. I'm also a business coach and also an independent director. I have delivered my training programs in more than 50 locations all over the globe. I was working with a company called ArcelorMittal, which is world's largest steel and mining company. And as part of ArcelorMittal, I have delivered training programs all over the globe in more than 50 locations across 5 continents, covering a very wide range of topics from the domain of finance, reporting, leadership, and work-life balance. Some of the locations where I have delivered the program would include all over the globe. So Ukraine, Kazakhstan, Russia, Asia, America, Europe, Africa, Middle East, and everywhere. I am very passionate not only in practicing yoga, meditation, and pranayama, but also in teaching it, because I'm very passionate about spreading the knowledge and understanding about the work-life balance, which is very crucial for every one of us. I'm a marathon runner. I have run more than 100 marathon as it stands today. And I'm also a cyclist, passionate cyclist, have cycled in Europe and many locations within India as well, including from Pune to Goa, Pune to Pandharpur, Pune to Shirdi, and many other places. I've authored 2 books. One is You Are a Born Winner, and second is Finance for Value Creation. Now, with this brief introduction, friends, let's now come to the income tax valuation rules 11U and 11UA for valuation in different situations. Now, I'm sure as part of your course curriculum, you would have read about it as to how critical and crucial it is to do the valuation as per the Income Tax Act. And within the Income Tax Act, the Rule 11U and 11UA play a very important role. And therefore, as the valuation professional or as the corporate professionals, as all of us are, it is critical and crucial for us to understand the Rule 11U and Rule 11UA. And that is what my endeavor going to be in this session today. So we start with Rule 11U. Now, what this Rule 11U is? This Rule 11U primarily is, it covers expressions used in determination of fair market value under the Income Tax Act. So for different aspects under the Income Tax Act, it defines certain terms which are used in the context of valuation as per the Income Tax Act. Now, what those terms are? First of all, it defines the balance sheet. And how does it define the balance sheet? Balance sheet, as per the provisions of the Companies Act, is the balance sheet defined as per Rule 11U. Merchant banker is defined as per the SEBI Act. So, how the SEBI Act defines the merchant banker, same definition is picked up for the purpose of Rule 11U. Quoted share or securities, we all understand any share which is listed or any security which is listed on a stock exchange, that is referred as quoted share or securities. Recognized stock exchanges, so the definition of recognized stock exchanges as given in Securities Contracts and Regulation Act in 1956, that is the definition assigned in Rule 11U for the recognized exchanges. Registered dealer का मतलब क्या है? What is the meaning of registered dealer? The meaning of registered dealer is someone who is registered under the Central Sales Tax Act 1956 or General Sales Tax Law for the time being in force. So now the Central Sales Tax 1956 is replaced by the GST law. So therefore, anyone who is registered under the GST as a dealer, so that definition is picked up by Rule 11U for the purpose of income tax. Registered valuer. Now here we have to be very careful, friends. Registered valuer, as commonly all of us understand, is a person who is registered with IBBI as a valuer. That is what is understood. But the definition of registered valuer as per the Rule 11U of the income tax rules is not same. It is different. And when I say it is different, what does it mean? It means the income tax department has a different set of rules for registering the professionals for the purpose of valuation. And that is as per Rule 34AB of the Wealth Tax Act 1957. So if you are a cost accountant, company secretary, chartered accountant, or a finance professional and have got a 10 years of experience of valuation or in practice, then you can register with the income tax department. There's a long process that you have to follow. So anyone who's registered following that process with the income tax department, he is referred as registered valuer under the Income Tax Act and Income Tax Rule. Securities is same as defined as per the Securities Contract and Regulation Act 1956. Unquoted shares or the shares of an entity or the shares of an entity which are not listed or an entity which is not listed on any of the exchanges, shares and the securities of that entity are referred as unquoted shares. And finally, most important, last but not the least, but most important, and that is valuation date. So how is the valuation date defined under the Rule 11U? And that is, it means the date on which the property or consideration, as the case may be, is received by the assessee. So for the purpose of income tax, what is the valuation date? Valuation date is the date on which the assessee, if he is a buyer, then he receives the asset. Or if he is a seller, then he receives the consideration. So the day on which he receives the consideration or the asset, depending on as to what role he is in, that date becomes the valuation date for the purpose of income tax, and that is Rule 11U. Now let's come to Rule 11UA. Now Rule 11UA, friends, remember, it is for determination of fair market value under different situation requiring valuation. So this Rule 11UA, as we will see as we move forward, is the rule that covers different situations where valuation is required as per the income tax law, and it prescribes as to how the valuation will need to be done in all those situations, who will do the evaluation in those situations, and what will be the methodology for the purpose of valuation in those situations. And that is what we are going to cover. So within the Rule 11UA, you have different sections and different methodology. So that is what we are going to discuss them one by one. So within Rule 11UA, you have Rule 11UA1. Now, this Rule 11UA1 gives you methodology for determination of fair market value of what? See, the Rule 11UA1 gives you methodology for determining fair value of jewelry, archaeological collections, drawings, paintings, sculptures, or any work of art, and shares and securities. So that is what is covered in the Rule 11 UA1. So Rule 11 UA1 provides methodology for the purpose of doing valuation of jewelry, archaeological collections, drawings, paintings, sculptures, or any work of art, and shares and securities. When it is going to be applicable? So it is going to be applicable as per all the sections of the Income Tax Act relating to valuation. And what is the valuation methodology? So the valuation methodology would depend, will vary from the asset to asset. So the valuation methodology for jewelry is going to be different from the valuation methodology of our archaeological collections and for the shares and securities. And that is what we will understand together. We will also along the line discuss as to under these different situations who would be the person who will do the valuation. So now let's move forward. And the first thing that we have as part of Rule 11 UA1 small a. Now this is small a is with regard to the valuation of jewelries. This is small a is for the valuation of jewelries. So what this Rule 11 UA1 small a, it talks about valuation methodology for the jewelry. And what does it say? It says the fair market value of jewelry shall be estimated to be the price which such jewelry would fetch if sold in the open market on the valuation date. So on the valuation date, if this is sold in the open market, what value will it fetch? That, number one, that is going to be the value of this jewelry. It also gives the second situation, and second situation is in case the jewelry is received by way of purchase on the valuation date from a registered dealer, the invoice value of the jewelry shall be the fair market value. So situation number one, jewelry, and there is no invoice. So if it is sold in the open market, the price that it would fetch, that becomes the value of that jewelry. That becomes the fair market value of that jewelry. Another situation when someone has bought a jewelry from a registered dealer and where he has got an invoice for that purchase. So the amount which is given in the invoice, that becomes the fair value. And then there is a third situation, and the third situation is in case the jewelry is received by any other mode and the value of the jewelry exceeds rupees 50,000, then the assessee may obtain report of a registered valuer. So that means any other situation, that means the jewelry that one has got is not is a purchased one, it is received in any other mode. In that case, what the assessee needs to do, he needs to go to a registered valuer. So when I say registered valuer, remember it means what? It means someone who is registered under section 34B of 34AB of the Wealth Tax Act. So someone who has got himself registered as a valuer with the Income Tax Department as a valuation expert for the jewelry, he will be considered as a registered valuer for this purpose. And that is what we always need to remember. So when we say income tax, that means we are talking a registered valuer who is registered with the Income Tax Department as a valuer. Then we come to Rule 11 UA1 small b. And this Rule 11 UA1 small b, it talks about valuation of archaeological collections, paintings, sculptures, or any work of art. So in this case, how will the valuation is done? The valuation is done, number one, the fair market value of archaeological collections, drawings, paintings, sculptures, or any work of art, hereafter we will refer it as artistic work, shall be estimated to be the price it would fetch if sold in the open market. And in case if it is purchased from a registered dealer, then the fair market value of this jewelry, of this archaeological collection, painting, sculpture, or any work of art would be as given in the invoice received from the registered dealer. And if both these situations are not applicable, in the third situation, the valuation will need to be obtained from a registered valuer. And I do not have to repeat what does it mean when I say registered valuer. That means someone who is registered with the income tax authority for the purpose of valuation. Then you have Rule 11UA1C. So you have a Rule 11UA1A, that is for jewelry. You have Rule 11UA1B, that is for archaeological collections, painting, sculptures, and work of art. And third is Rule 11UA1C, small c, and that is determination of quoted shares. So how to do the evaluation of quoted shares? And the Rule 11UA prescribes the methodology for the valuation of quoted shares. Now, what does it say? So there can be two situations. Situation number one, that is valuation of quoted shares and securities when transacted at a recognized stock exchange. So when the transaction is done on a recognized stock exchange of the shares and securities, in that case, the fair market value of such transacted shares, quoted shares or quoted securities, will be the quoted price on a recognized stock exchange. On a recognized stock exchange. Who can do the valuation of such transactions? There is no need for any valuation to be done in case when the shares have been transacted on a recognized stock exchange. There is no need to have a separate valuation. The contract note that a person would receive for buying or for selling, depicting the buy and sell price, is good enough as a reference for determining fair market value of the shares which have been transacted on a recognized stock exchange. Remember, it can also happen that you not only do the transaction on recognized stock exchanges, but many times the deals are done of the stock exchange, of the stock exchange. So this rule also talks about valuation of quoted shares when transacted other than at a recognized stock exchange. So a transaction in the quoted securities has been done, but not on the stock exchange, but not on the recognized stock exchange. It has been done of the recognized stock exchange. So how would the valuation be done in such case? How will the fair market value be determined in such case? And that is quoted price on the recognized exchange will be the fair market value. And in this case, report from a chartered accountant or from a income tax registered valuer in confirmation of quoted price is advisable to keep on your record, to keep it on your record for your future reference. So now, having understood how valuation is done of jewelry or of archaeological collections, painting, sculptures, and also the quoted securities, now we move to the next aspect, and the next aspect is valuation of unquoted shares. So remember, friends, as you would have noticed, as regards the valuation of quoted share, there is no challenge. And why there is no challenge? Because it's a quoted security, quoted share. Therefore, the valuation is based on the quoted price. If the transaction has been done on a recognized stock exchange, then the price of that exchange becomes the fair market value. It has been done off market transaction. In that case, the value will be determined based on the price on the day of the transaction on any recognized exchange, and that is what the fair market value will be determined. The question is with regard to the valuation of unquoted shares, and I'm sure all of you must have already faced such situations where the unquoted shares are to be valued, and that is where the real challenge is as to how to do the valuation of unquoted shares. That means shares which are not listed on any stock exchange. How to do the valuation? Now, for this purpose, what we need to do, firstly, we need to understand what is the philosophy and objective of the department behind the Rule 11 UA1CB. So, as part of the Rule 11 UA, you also have a sub rule, that is 1 small c small b. Now, this Rule 11 UA 1 small c small b, it gives the methodology for the valuation of the unquoted shares. Unquoted shares. Now, for all of us to be able to understand as to what is, and there's a formula, and I'm going to share that formula with you. So we need to understand as to why the income tax department or the income tax authorities have specified this valuation formula. What is the reason behind it? What is the objective behind it? So the answer, of course, is very simple. The answer is what the department wants by prescribing this method of valuation of unquoted shares, which in common parlance is referred as NAV, net asset value method. What is the objective? The objective of the department is very simple. The objective of department is the valuation should be done in a way that the assets are not understated and the liabilities are not overstated. So if someone is doing valuation of unquoted shares of an entity, and if he is understating the assets and he is overstating the liabilities, what is he doing? He is depressing the fair market value of the shares of that company. What is the outcome? The outcome is, since he is depressing understating the assets, overstating the liabilities, he is depressing the fair market value. So if he is going to depress the fair market value, then it is possible that on paper they will do a transaction. The buyer and the seller will do a transaction where they will be agreeing for a lower price. Thereby, the capital gain that will accrue is going to be lower, and as a result of that, the department is going to lose on the revenue. So the purpose and the objective of the department behind the Rule 11 UA1CB is to ensure that people do not resort to such gimmicks to avoid the tax, and that is why you have this methodology under Rule 11 UA. Now, let us understand what this formula is and how does it work, and what are the different critical aspects of this methodology of Rule 11 UA1CB. Let us understand that together. So the Rule 11 UA1CB, which is for the purpose of valuation of unquoted shares, and by now we are very clear that as regards the quoted shares, valuation is not an issue because the quoted price becomes the basis for the valuation of quoted shares. The challenge is with regard to the valuation of unquoted shares, and for the valuation of unquoted shares you have 11 UA1 small c small b. So this Rule 11 UA1 small c small b prescribes a formula, and what that formula is A plus B plus C plus D minus L into PB divided by PE. So what does A stands for? A stands for all the assets as given in the balance sheet. All the assets as given in the balance sheet except B, C and D. What is B? B is jewelry. What is C? C is archaeological collections, painting, sculpture and the work of art. What is C? C is your unquoted shares. And what is D? D is the immovable property. So asset would mean all the assets given in the balance sheet except B, C and D. And why except B, C and D? Because B, C and D are valued separately. They are not, when you are doing valuation as per 11 UA1CB, you do not pick up the jewelry at the book value. You do not pick up the unquoted shares at the book value. You do not pick up the archaeological collections, painting, sculptures, and the work of art on the face value. You value them separately. You value them separately. And how do you value them separately? We have already seen. So we have seen how to do the valuation of jewelry, how to do the valuation of archaeological collections, painting, sculpture. We have also seen how to do the valuation of these things. And now what we are doing, now we are seeing the how to do the valuation of C, and that is unquoted shares. So unquoted shares will also be excluded. And then D, as I said, D is also not valued at the amount which is given in the balance sheet. D is immovable property. For the immovable property, also this formula specifies a different methodology, and I'm going to share as to what that methodology is. And what is L? L is the liability. But remember, not all the liabilities. There are certain liabilities which are to be deducted, certain liabilities which are not to be deducted, and that is what we will understand. What is PB? PB is number of shares that you are wanting to transact for. Number of shares that you are wanting to transact for. And PE is the total number of shares of that entity. PE is the total number of shares of that entity. So this is the formula which is used for the purpose of finding out valuation of unquoted shares following Rule 11UA 1 small c small b. Now who can do the valuation? Who can do the valuation in case of unquoted shares? Now friends, remember, as you can see and as we have discussed, the valuation as per Rule 11U1 small c small b is based on the balance sheet. So really speaking, since it is based on the balance sheet, you do not need an external agency for the purpose of doing the valuation. But as we have understood, a company whose unquoted shares we are trying to value, that company may have in its balance sheet jewelry, it may have in its balance sheet painting, sculpture. So those will need to be separately valued, or those will need to be separately valued from someone else. So that is what we need to remember. And for that purpose, you must approach an income tax registered valuer so that he is able to ensure that the formula which is prescribed by under Rule 11UA1 small c small b is fully met. We can take help of someone who is income tax registered valuer. Let me now expand this formula for bigger and better understanding. So Rule 11UA1 c small b is for the valuation of unquoted shares, and what this formula is, we have understood in principle as to what this formula is. Let us further expand all these components part by part. A. So what A would mean in this formula? A would mean book value of all assets other than jewelry, artistic work, shares, securities, and immovable property. So as I've just mentioned already, that is what we will need to ignore when we are doing the valuation of a company's unquoted share. In the balance sheet as reduced by, so whatever amount that you have taken from the balance sheet for the purpose of 11UA 1CB valuation, from the total of those assets, you will need to reduce, number one, any amount of income tax paid, that is advance tax, if any, less the amount of income tax refund claimed, if any. And that is what you will need to do. So for example, if the company has paid an advance tax and TDS put together of 100 crore, company has claimed a refund of rupees 20 crore. So that means the difference of 80 crore will need to be deducted from the total of all the book value of all these assets. That is number one. Number two, any amount shown in the balance sheet as an asset, including unamortized amount of deferred expenditure. Now remember, this also will need to be deducted from the total of book value of all the assets. and understand why this unamortized amount of deferred expenditure needs to be deducted, because I am sure we will know it very well that any item of unamortized amount of expenditure appearing the balance sheet is, really speaking, is a fictitious item. It is a fictitious asset. This number, this item does not represent any asset. So this is an asset only on paper, and therefore this has to be deducted from the book value of all the assets. Now let me pick a few posers for you friends. And the poser number 1, will A, and I'm sure you will know when I say it would mean what it means, all the assets other than, so the A of the formula A plus B plus C plus D minus L. So the A of that, the question is, will A in the above formula include intangible asset? And the answer is yes. So any asset which is reflecting on the balance sheet of an entity will be part of A in any case. And remember, what will not be part of A is only number 1, jewelry, number 2, the archaeological collections or art of work, and number 3, C, and that is your unquoted shares, and number D, that is your immovable asset. Will capital work in progress on account of tangible as well as intangible asset be considered in computation of fair market value? And the answer is yes. The answer is yes. Why? Because any capital work in progress in respect of a tangible asset or intangible asset, remember, is a genuine asset that you have, right? So it will be part of your A. Which balance sheet should be used for the purpose of determination of valuation of unquoted shares? Or in other words, what should be the date of the balance sheet for the purpose of fair market value determination? So this is the question which is prevalent everywhere, and there is a lot of discussion about it. When you are trying to do the valuation of unquoted share of a company, what should be, because we have seen that for the purpose of valuation here, what do we need? We need a balance sheet. We need a balance sheet. So the question is, what should be the date of the balance sheet? What should be the date of the balance sheet? There is a confusion, there is a ambiguity in the minds of people. Some people feel that Rule 11 UA 1 CB talks about the balance sheet, so it has to be the balance sheet of the date of transaction. Now, in my view, that view is not correct. It is fair enough to pick up the audited balance sheet or the last audited balance sheet. Pick up the last audited balance sheet and make the adjustments for all the changes that would have taken place from the time of the last balance sheet till the time of doing the transaction. So if there are any changes in the assets or the liabilities, you can make those adjustments in separate working, and that working, in my view, should be good enough for the purpose of finding out the value, the fair market value of unquoted share as per Rule 11 U1CP. Why do I say this? And that is because, remember, the purpose of valuation is not to check the arithmetics. The purpose of valuation is not to get into the computations in the calculations. The purpose of the valuation is to take a decision. So long as you are not knowingly or unknowingly indulging into over or under valuation, it is good enough that you pick up the last audited balance sheet and make the adjustment in that balance sheet for the changes that would have taken place since the time of the last balance sheet till the date of your transaction. Make the adjustments, take that document on your record, have it certified from a chartered accountant, so that it is established that whatever has been done, whatever working that you are taking as a base is authenticated by a qualified and competent professional, and that, in my view, should be good enough. Is an audited balance sheet required or an unaudited balance sheet will also do? I think I have already just answered this question. How to treat brand value of the business not reflecting in the balance sheet? So it is possible the company which is not listed, whose shares you are trying to value. Now this company over the years may have created a lot of brand value for itself because of the name, fame, reputation, credit worthiness, and so on and so forth. So the question is, should this brand value also reflect in the calculations of fair market value of the unquoted share of this company? Answer is no. And why the answer is no? Remember, this methodology that is prescribed as per Rule 11 UA1CB is net asset value as per the balance sheet. So if any brand value that the company has created for itself, but it is not reflecting in the balance sheet of the company, then this brand value is to be simply ignored. Let's move further on this formula, and then we have a component B. So we have discussed and seen what does the component A includes or comprises of. Now let us look at as to what is the component B. So the component B is the price which the jewelry and artistic work would fetch if sold in the open market on the basis of the valuation report obtained from a registered valuer. So it is possible that in the balance sheet of this company, whose unquoted share you are trying to find fair market value of, this balance sheet may have jewelry. So this jewelry may be there in the balance sheet of the company for last 15-20 years. Now if that be the case, you obviously cannot take the book value of the jewelry which is carried forward for last 25-30 years. You need to find out the current market value of this jewelry for the purpose of calculating fair market value of the unquoted share. Now another thing is C. What is C? And this is very interesting and you must pay attention here. C is fair market value of shares and securities as determined in the manner provided in this rule. So that means what we are talking about? We are talking about you are trying to find fair market value of unquoted shares of XYZ. Now this XYZ in its balance sheet also have unquoted shares of company ABC. So what you have to do now? Can you take the book value of the shares of ABC which is reflecting in this company's XYZ's balance sheets? And the answer is no. You will have to indulge into another valuation exercise where you will have to value the balance sheet the unquoted share of ABC, which is also carrying unquoted share of some other entity. So that is what you will have to do, and that value you will take here. C is that okay, and D of course is the value adopted or assessed or assessable by any competent authority of the government for the purpose of stamp duty in respect of immovable assets. So as we discussed, D we have to exclude when we are taking the as A, and so immovable property again. So a company may have a land and building appearing in its balance sheet carried forward for 20, 30, 40, 50 years. Obviously the land would be shown at a very small price because 30, 40, 50 years when the land would have been bought at a very small price. So when you are doing the valuation for the purpose of Rule 11 UA1CB, can you take the old price? Answer is no. So what price do you take? Now for this immovable property, you will have to find out as to what is the value adopted or assessed or assessable by any authority of the government for the purpose of payment of stamp duty. So that means if this land or building, if it is sold today, what value the government authority, the registrar, who would do the registration of this property, what value, what reference rate he will take for the purpose of assessment of stamp duty on this transaction. So that value will need to be taken as the value of D, and that is the value of the immovable property. Let us take friends few more posers. So the poser number 7 is how to value unquoted shares of other unlisted companies appearing in the balance sheet of the unlisted company whose unquoted shares are being valued. I think I have already answered this question, this poser. So we are doing the valuation of XYZ. XYZ is unlisted. XYZ's balance sheet is also having the shares of ABC. ABC is also unlisted. So now what we will need to do, we will need to follow this process of Rule 11U1CB not only for XYZ but also for ABC, so as to reflect correct value of the unquoted shares of ABC which are reflecting in the balance sheet of XYZ. The entity has jewelry and artistic work appearing in its balance sheet which was bought by the entity 5 years back, for which the invoice from a registered dealer is also available. Can the entity consider this price given in the invoice for the valuation of this jewelry and artistic work? The answer is no. And why the answer is no? Because your invoice is 5 years back. So in 5 years back, the value of the jewelry or the artistic work would have undergone a change. And mostly it would have undergone an upward change. And therefore, now you cannot take the invoice that was 5 years back. Now you will have to obtain a valuation report from an income tax registered valuer who is authorized to do the valuation of jewelry. Let's further move and come to the last part of this methodology or this formula. So component L, we discussed L would mean book value of liabilities shown in the balance sheet but not including the following. So what is L? L is liability. But L is a liability for sure, but it does not mean all components which are there in the balance sheet of the company are to be deducted. No, not all the components are liabilities are to be deducted, but not the liabilities, not all the liabilities. So which are the liabilities that are not to be deducted? Let us understand them. So number one is the paid up capital. So when you arrive the total of A plus B plus C plus D, that means now you have the total of all the assets, and from this total you have to deduct the liabilities. Which liability? All the liabilities which are appearing in the balance sheet of the company except number one, paid up share capital. You do not have to deduct. And why? Because paid up capital, equity share capital, that is what you're trying to value. So that is what you're trying to find value. So equity share capital, paid up share capital will not be deducted. Number two, the amount set apart for payment of dividends on preference shares and equity shares, where such dividends have not been declared before the date of transfer at a general body meeting, right? So any provision of dividend, whether on preference share or on equity share, which is appearing in the balance sheet of a company as a liability, but this dividend has not been declared and approved by the shareholders in their meeting. So remember, this also will not be deducted from the total of the assets. And why will this not be deducted? Why this amount of dividend will not be deducted? This amount of dividend will not be deducted because dividend becomes a liability only when it is declared and approved by the shareholders. Number three, reserves and surplus. So reserves and surplus, by whatever name called, even if the resulting figure is negative, other than those set apart towards depreciation. So the figure of reserves and surplus which appears on the side of the liability side of the balance sheet will also not be deducted. Why? Because we all understand reserves is nothing but part of equity. Reserves is nothing but part of equity. That means what? That means reserves is not something that you have to pay to the external agencies. Reserves is something that belongs to the shareholder only. So as you don't deduct the equity share capital, likewise you don't deduct the reserves and surplus also from the total of all the assets, that is A plus B plus C plus D. Number four is any amount representing provision for taxation other than amount of income tax paid, if any, less the amount of income tax claimed as refund, if any, to the extent of the excess over the tax payable with reference to the book profit in accordance with the law applicable thereto. Now, what does it mean? It simply means that you can deduct from the total of the assets the amount of tax liability which is due, which is based on the working. If you are making any extra provision on account of tax liability, that extra provision is not allowed to be deducted from the total of all the assets. So you can deduct the provision of the income tax, which is really the amount that company has to pay. Any excess provision that you make is not to be deducted from the total of the assets. So if there is a tax provision in excess of the amount of tax payable, that excess amount will not be deducted as part of the liabilities, meaning thereby it is not a deductible liability. Now, few more posers, friends. Is preference share capital a deductible liability? So we have understood A plus B plus C plus D, how they are to be arrived. We have also understood as to what all will be part of L. Now there are a few questions, few posers, which I thought I would share with you. Number one is preference share capital a deductible liability? So that means, will the amount of preference share capital need to be deducted from the total of all the assets A plus B plus C plus D? Answer is, of course, yes, because this is a liability which is due by the company, not to the shareholders, not to the equity shareholders, but other than the equity shareholders. So anything which is due to other than the equity shareholders will be deductible. Next poser is how to treat compulsorily convertible preference shares CCPS or the compulsorily convertible debenture, that is CCDs, or the convertible warrants. And answer, of course, is very simple. Going by the same logic, so the amount of CCPS appearing in the balance sheet will need to be deducted as a liability from the total of all the assets. And so is the case with the compulsorily convertible debenture. So any amount reflecting in the balance sheet on the liability side on account of compulsorily convertible debenture, remember this is again a liability, it will need to be deducted for the purpose of computation of fair market value as per Rule 11 UA1CB. What about the convertible warrants? Now please remember, convertible warrants as it stands, they are not a liability. They are convertible warrants are a contingent transaction. So if the company has issued convertible warrants to the shareholders, then as it stands today, as it stands on that day, it is still off balance sheet item. So the convertible warrants will not reflect in the balance sheet of a company. Convertible warrants will be part of the notes of the company. This is a off balance sheet item, and therefore convertible warrants, since they are not part of the balance sheet in any case, will not be deducted. How to treat optionally convertible debenture? So in case if the company's balance sheet is reflecting optionally convertible debenture, how to treat them? Remember, it is optionally convertible debenture. It is a liability reflecting in the balance sheet, liability due to other than equity shareholders, and therefore any amount which is reflecting in the balance sheet on account of optionally convertible debenture will also need to be deducted from the total of A plus B plus C plus D. Is share premium a deductible liability? Again, the answer is same. Share premium belongs to whom? Share premium belongs to the same people to whom the reserves and surplus belong. Whom the reserves and surplus belongs? To the shareholders. So whether it is equity share capital, or it is reserves and surplus, or it is share premium, all of them, remember, are part of the shareholders fund, and therefore the amount of share premium will not be deducted from the total of A plus B plus C plus D. How to treat other than those set apart towards depreciation? I think it is already dealt. How to treat asset valuation reserve, if there is any? So in case in the balance sheet of a company, you see asset valuation reserve. So how do you treat the asset valuation reserve? So remember, friends, as far as the land and building is concerned, land and building are to be valued based on a government authority. So therefore, if the asset revaluation reserve is on account of revaluation of land and building, it is to be simply ignored. And why it is to be simply ignored? Because any increase in the land and building in the balance sheet on account of revaluation is of no consequence. What is of consequence is the value of that land, that immovable property, which is used by the government authority for assessing the stamp duty liability. So the asset revaluation reserve is to be simply ignored. Now, then you have component 5. Any amount representing provisions made for meeting liabilities other than ascertained liabilities. So, understand the logic. So, if a company has made provisions of certain liabilities which are not ascertained, and those liabilities are shown in the balance sheet. Now, if you deduct these liabilities, these liabilities on account of unascertained liabilities, these provisions on account of unascertained liabilities, if you deduct this amount from the total of the total of all the assets A plus B plus C plus D, what is the consequence? The consequence is the fair market value of the unquoted share will decrease. What is the consequence? The consequence, the amount of capital gain will reduce. What is the consequence? The consequence is the department will get lesser amount on account of the revenue. And therefore, this formula provides, if the company has made any provision on account of unascertained liability, now those liabilities are also not to be deducted from the total of A plus B plus C plus D. 6 is any amount representing contingent liabilities. So what do you do with the contingent liabilities? So please remember, contingent liabilities are contingent liabilities. In any case, they are not part of the balance sheet. So since they are not a part of the balance sheet and they are only contingent liability, they are only below the balance sheet item. That means what? That means any contingent liability while computing the fair market value of unquoted shares as per the Rule 11 UA1CB, the contingent liabilities are simply to be ignored. We have understood what is P and we have also understood what is PE, right? So PB would mean the paid up value of such security shares. That means the shares that you want to value, and the PE would mean the total amount, total number of shares that you want to value. So whether you talk in terms of total number of shares that you want to value, or whether you talk in terms of total paid up value of the shares that you want to value, both would mean the same thing. Now, a few more things that I thought I would share with you. Liabilities listed at 1 to 5 that we have seen are not to be deducted, as really speaking, these are not the external liabilities of a company, right? So what we have seen here, these are the liabilities. So 1, 2, 3, 4, and this is 5. And this is 5. So these are not to be deducted because these are not liabilities. These are not external liabilities in any case. Rather, these either represent equity or shareholders' funds, or have not become a liability of the company as yet. Hence, are not to be deducted. Let's take a few more posers. When to use Rule 11 UA1CB for determination of fair market value of unquoted shares. So there is a confusion in the minds of some people, and that is it mandatory to use the Rule 11 UA1CB for determination of fair market value of unquoted share, or when should this methodology of Rule 11 UA1CB should be used? Now, based on the experience, I can say that valuation as per Rule 11 UA1CB should be done when the company is profit making and when the company has a positive net worth. When a company has a positive net worth. And why do I say this? I say this because the entire methodology under Rule 11UA1CB is to arrive at the net asset value. So if a business has, if a business has uh, negative net worth, that means the book value is minus. So if the book value is minus, then how do you do the valuation? Because if you use Rule 11UA1CB to value an entity whose net worth is negative, so using the Rule 11UA1CB, you will only arrive at a negative figure, and therefore it won't serve your purpose. So therefore, in my view, Rule 11UA1CB should be resorted when the business is running, profit making, or at least its net worth is still positive. In that case, you can use it. Second situation, the book net worth may have become negative. Please remember. So second situation, when you can use Rule 11UA1CB, when the book net worth has become negative, but because of the fair market value of the jewelry or the unquoted shares of other companies that this company is having, or the fair market value of archaeological collections or the work of art, or the fair market value of land and building. So if the total of the fair market value of the jewelry, artistic work, unquoted share, and immovable property, if the fair market value of these four assets is so high that the negative net worth of this entity becomes positive by virtue of additions of these fair value of these four assets, in that case also Rule 11UA1CB can be used for the purpose of a business which is having a negative net worth. Can a loss-making company be valued based on Rule 11UA1CB for determination of fair market value of unquoted shares? So remember, as I said, loss-making will not make any difference. Profit-making also will not make any difference. What will make a difference is what is the situation of the net worth. If the net worth is negative, then a use of Rule 11UA1CB formula will not work, because the net worth is already negative. But if the net worth becomes positive by virtue of increased fair market value of jewelry, archaeological collections, etc., and the unquoted shares and the immovable property, in that case also the Rule 11UA1CB can be used for the purpose of doing valuation of such an entity. How to do valuation of a loss-making company having negative net worth for determination of fair market value of its unquoted shares? I think I have already answered this question. How to do valuation of unquoted shares of a loss-making company having negative net worth and no potential to turn around? So there is a company, negative net worth is negative, and the company has no potential of getting turned around. So my question is, why do you want to do the valuation of such an entity? Because this entity has no potential of turning around. So the only thing that you can do and you should do is to dispose that entity off instead of getting into the valuation. And next is, what are the consequences of Rule 11UA1CB based valuation on the transaction price? So please remember, transaction price is always independent of the valuation that you arrive at. So be clear in your mind, whenever someone is doing valuation of any entity, any business, any liability, any security, so the valuation that person is doing, he is not going to tell as to what should be the transaction price. He is not going to come out with as to what should be the price at which the transaction should be done. He is only giving a reference rate. Now, in case of the Rule 11UA1CB, what is the consequence? The consequence is you do the valuation of the unquoted shares using the rule 11UA1CB, arrive at a price. Now, if you are doing the transaction, so let's say you have arrived at a price of 100 rupees. Now, if you are doing the transaction or at 110 rupees, income tax department will be happy. And why the income tax department will be happy? Because even though using the rule 11UA1CB, the value of the unquoted shares was coming to be 100 rupees, but you are doing the transaction at 110 rupees. So the department will be happy because the department is going to collect more tax. But having used the rule 11UA1CB, the valuation is coming at 100 rupees and you are doing the transaction at 80 rupees. Now that will not be acceptable to the department. So the department will say, you do the transaction at whatever price you want to do. We have no problem. You pay the tax, assuming that you have done the transaction at 100 rupees. And that is the consequence of following the rule 11UA1CB. Why has the department not included DCF for rule 11UA1CB? DCF method would give more value, so more capital gain, thereby more capital gain tax for the department. Now, in my understanding, friends, when the department prescribes rule 11UA1CB for the valuation of unquoted shares, by no means it is saying that you should not use the discounted cash flow method. It only is saying that your value should be at least as much as your transaction value should be as much as it is coming following the rule 11UA1CB formula. So long as the transaction value that you are arriving at is at least equal to the price or the amount that you arrive using the rule 11UA1CB, department is happy. So if you want to use the discounted cash flow method and the price that you are arriving at is higher than the price that you would have arrived at using the rule 11UCB formula, department will have no reservation, no objection. Department will be happy. The only challenge that that one has experienced is, for some strange reasons, the department has disentitled the chartered accountants for using the discounted cash flow method while doing the valuation for the purpose of income tax. So that may be the only challenge. But in my view, if you are able to establish that using the discounted cash flow method, the price that you have arrived is much higher than the price that you would have arrived at if you would have used the rule 11UA1CB formula, I am sure department will not have any reservation, should not have any reservation, because they are getting in any case more tax than what they would have got otherwise. Will the indexation benefit be available for Okay, so will the indexation benefit be available for the unlisted securities held by unlisted entity in valuation of its unquoted shares? So the answer, of course, is very simple, and the answer is it is not applicable. So someone can ask a question, when you are doing the evaluation of unquoted shares of a company, will you get the benefit of indexation? The answer is no. And why the answer is no? Because it's not applicable. Remember why it is not applicable, because indexation is for finding the deemed cost of acquisition in case of certain capital assets. Indexation is for that purpose. Whereas fair valuation is to find the likely selling price. And therefore, in case of valuation of unquoted equity shares, indexation becomes irrelevant. So indexation you will be interested in or will be applicable when you are trying to sell an asset, right? You are trying to sell an asset which you purchased many years ago. So that is where you will be interested in using in increasing your deemed cost so as to reduce your capital gain, which is not the case when it comes to the valuation of unquoted market share, and therefore indexation will be irrelevant in case of the valuation of unquoted shares using the formula under Rule 11 UA1 CB. Okay, so I think I have discussed them already, and therefore now we can come to Rule 11 UA1CC. So Rule 11 UA1CC is the methodology for determination of fair market value of unquoted shares and securities other than equity shares in a company. So what is this? This is nothing but preference share capital. Preference share capital. So how to do the valuation of preference shares? Unquoted preference shares. So this is how we will do the valuation of unquoted preference share. So the rule that is applicable is Rule 11 UA1CC. And when will it be applicable? It will be applicable fair market value of unquoted shares and securities other than equity shares, which is nothing but preference shares. Valuation methodology. Price it would fetch if sold in the open market on the valuation date. Who can do this valuation? A report by a merchant banker or by income tax registered valuer, and in this case even a chartered accountant can also do the valuation. So how will you do the valuation of preference shares as per Rule 11 UA1CC? It will be basically fair market value of preference shares and other fixed income securities shall be done taking into account the periodical cash flow, redemption amount, and the prevalent market interest rate. So this is how you will do the valuation of the preference shares. So just a quick summary of what we have discussed. Rule 11 UA1CC. If the shares are quoted and the transaction is done at the recognized stock exchange, then the transaction value becomes the fair market value. If it is not through a recognized stock exchange, in that case, when there is a trading on valuation date, lowest price quoted on any recognized stock exchange. So the day when this off stock exchange transaction was done, if there was a trading on any of stock exchanges, the lowest price quoted will be the value, fair market value. And when there is no trading on the valuation date, then lowest price quoted on any recognized stock exchange on a date immediately preceding the valuation date when such security was traded. So that will be the fair market value. In case of unquoted shares, it is Rule 11 UA1CB, which is breakup value, but it is also referred as NAV. Other unquoted securities, as we discussed, price that it would fetch in the open market as determined by the income tax registered valuer or a chartered accountant or a merchant banker. Now we come to another very important aspect, friends. Having understood valuation and the different aspects of the valuation report. So as a valuation professional, when you complete your job, you have to summarize your job in the form of valuation report, and that is what is going to be useful for your client. So there are certain things that we need to remember when it comes to the valuation report. Please remember, document everything done in the course of valuation and prepare the valuation report as per the valuation rules, valuation standards, and the IBBI regulations. That is what is required. The valuer shall in his report. So what all we have to state in the valuation report. So our valuation report should include, number one, background information of the asset being valued, purpose of valuation and appointing authority, identity of the valuer and other experts involved in the valuation. So that is about yourself. Disclosure of valuer interest conflict, if any, date of appointment, valuation date, and the date of the report. What are the sources of information that you have used for the purpose of doing the valuation? Procedures adopted in carrying out the valuation. So your valuation report also has to narrate as to what all steps you have followed for doing the evaluation. So you also need to mention which are the approaches and the methods you have used, which are the approaches and methods you have not used. So that also you need to explain. What is the evaluation methodology that you have used? Major factors that influenced the evaluation, conclusions, caveat, limitations, and disclaimers. Now this is again a very important. So caveat, limitations, and disclaimers, what would it would mean? So we all understand disclaimers. So basically you need to write also in your valuation report as to what are the things for which you can be held responsible and what are the things for which you cannot be held responsible. So you need to clearly bring out as part of your valuation report so that it is clear. So you need to bring out as to what have you considered, what you have not considered, right? So whom have you relied on, whom you have not relied on. So all that will need to be mentioned as part of your caveats, limitations, and disclosure. Is very, very important that you have to show. What are the qualitative characteristics of a valuation report? So please remember, ultimately all the good work that you have done in doing the valuation, that has to reflect in your report. So your valuation report must have certain characteristics. Number one, it must be understandable, it must be relevant, it must be material, it must be reliable, it must have the faithful representation, it should have substance over form, it should be neutral, unbiased, should have prudence, and it should have completeness. So these 9 characters must be there in the valuation report that you prepare so that your client gets what he is looking for. Now let's come to the last part of our discussion today, and that is model code of conduct for registered valuer. So friends, please remember we discussed in part 1 and also in the beginning of this session, the purpose behind bringing out the valuation rules is not to provide another stream of cash flow to the professional. The purpose of the government of India and the Ministry of Corporate Affairs behind bringing out these valuation rules is to ensure that there is a higher level of corporate governance in the country, and therefore it is imperative for all of us as the valuation professional that we follow highest standards of ethics and professionalism when it comes to the valuation. And as a part of the valuation rules, it also has got model code of conduct for registered valuers, which is covered in Rule 12E of the company's registered valuers and valuation rules 2017. So these are the aspects that need to be followed, adhered to by the valuation professional, and which is very much expected. So what these model code of conduct is: number one, integrity and fairness. So as a professional, as a valuation professional, we need to ensure that we are fair in our dealing and we have very sound integrity. Confidentiality. As a business, as a valuation professional, we have access to a lot of information as regards to our clients. We have to maintain confidentiality of the same, and that is what is expected from us as part of the model code of conduct. So confidentiality. Having said that, let me also tell you, we are not supposed to disclose or divulge any confidential information. However, the law permits, and that is when statutorily we are not supposed to disclose or divulge any information without the prior information or confirmation or intimation from the company. But the law permits that as per the law, if you are required to disclose certain information, even if the permission is not coming from the client, you can still do it because that is what the law requires you to do it. The third code of conduct item is remuneration and cost. So that is what has to be taken care of. It simply would mean that ultimately ethics would mean that you charge based on the value that you are giving. You charge based on the service that you are providing. So it is expected from all of us as business professionals or valuation professionals that as regards the remuneration, of course this is subjective. This is not very easy to define and differentiate, but it is expected that the remuneration that we charge is commensurating with the services that we offer. And remember, it is both ways. It is both ways. So when I say both ways, what does it mean? It means that as valuation professionals, not only we should stay away from overcharging a client unduly, we should also stay away undercharging a client just to undercut the competition, just to undercut someone. That is also not expected. That is also not ethical. So that is what we have to do. Do not disproportionately charge remuneration. At the same time, do not charge under professional fees just to snatch the work from someone and things like that. Professional competence and due care. So it is expected as valuation professional that we maintain professional competence and take due care. Now, what does it mean? It means the world of business is changing every day. So things are changing. So it is expected as part of the model code of conduct that we as valuation professionals should keep ourselves continuously abreast with latest changes so that we are able to give a better service to our client and help him arriving at better corporate decisions. And that is your professional competence and due care. Information management, it would mean that whatever documents are generated, whatever information is created in the course of the valuation exercises, there must be a proper management of all those informations which are collected so that these informations are readily available for being presented with any statutory authority or any other person where these informations or documents and details may be required to be presented. And so that means as valuation professionals, it is expected that we have a very good information management system in our office, in our premises. Next is occupational employability and restrictions. So obviously, if you want to practice as a valuation professional, you cannot do it concurrently with being in the employment. So if you are working in a full-time employment with anyone, you cannot practice as a valuation professional. Yes, it is permitted if you are practicing as a chartered accountant, cost accountant, company secretary, or a management consultant in the domain of finance. In that case, you can simultaneously practice as a valuation professional, but you cannot do so when you are in full-time employment. And the logic and reason, as I would think, is when you are working in an employment, remember, you are working under someone, and therefore you do not have the freedom of determining as to what you should do, what you should not do. But when you are practicing as a professional, as a chartered accountant, cost accountant, and company secretary, you have the freedom to decide as to what should you work on, what you should not work on. And therefore, it is expected that as a practicing professional, even if you practice as a valuation professional, you will be able to do the justice with the profession, both the professions. Independence and disclosure of interests. So obviously, it is expected that as a value, because since it is for a good corporate governance, it is expected that as a valuation professional, we maintain independence from our client. That means other than the valuation that we are doing for the client, there must not be any other consideration from either side whatsoever. So that independence has to be maintained, and we have to give disclosure to the authorities, and not only to the authorities, but also, when we give the evaluation report, we have to mention it exactly. Gifts and hospitality, of course, not expected. So as a valuation professional, you should neither indulge into giving gifts nor indulge into taking gifts. You should not do anything that will bring a bad name to the profession. So with this, friends, we come to the close of part 2 of this session. Valuation, friends, is an amazing area. It's a very interesting area of profession. It gives you opportunity of using your imagination, using your creativity, and directly helping the corporates in adding value and in creating value. And but at the same time, there are challenges and there are requirements that we have to fulfill from time to time. So with this, we come to the end of this session. Thank you so much.